Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we are discussing the June market update for 2024, June 2024 property market update. I'll then give you a forecast of where we're heading based off the 18-year land cycle. So the national Australian property market continued its upturn for the 16th consecutive month, according to CoreLogic data. Brisbane, Perth, Adelaide continue to lead the charge with the upturn. Investors are now flocking in with FOMO. There is a shortage of sales listings and a very strong demand pressures. Brisbane is now the second most expensive city behind Sydney, with properties selling within a week of being listed, making it a very competitive property market ahead of the 2032 Olympic Games. So 16 consecutive rises, 13% up since the commencement of the upturn. And next slide. This shows the for June 24. So Sydney 0.5%, Melbourne's going backwards. Brisbane, Adelaide, Perth, strong growth. Hobart, Darwin, ACT, we don't really care much about those markets. So it's just the main Sydney, Melbourne, Brisbane, Adelaide. So strong run from Brisbane, Adelaide, and Perth continue to outperform in the second half of the cycle and also their respective regions. And over the past 12 months to June 2024, Sydney's up 6.3%. Melbourne's up only 1.3%, so flat, stagnated growth. Brisbane 15.8%, Adelaide 15.4%, and Perth 23.6%. So solid growth from Brisbane, Adelaide, and Perth. They are well and truly in boom times, and investors are flocking in like no tomorrow. So Melbourne now has dropped to being the fourth highest medium dwelling value. So typically it's in second place behind Sydney, but it's dropped down to being fourth due to the amount of growth out of Brisbane, Adelaide, and Perth, and the backwards growth for the last 4 to 5 years. So people are now very negative of the market down in Melbourne, stagnating since about 2017, 2018. The state government hasn't also helped as well by bringing in taxes policies, including a land tax threshold of 50,000. So that is also driving investment out of the state. Rental yields are now starting to look very attractive as prices are softening. In Melbourne, rents are still rising because there's a restriction of supply of stock, but also when people are selling out investment wise, there's lesser rental accommodation. So that's driving rents higher. So the intrinsic value is really looking attractive right now in Melbourne. So I do see probably Melbourne stagnating for the next 3 to 4 years, but now is the time to be actively acquiring in a soft market such as Melbourne. Rather than Brisbane, Perth, Adelaide, I believe they are well and truly set on their course and almost missed the boat if you haven't got into those markets already. Good time to be refinancing, drawing equity to then redeploying down into, say, Melbourne and Victoria. But yeah, now's the time to be harvesting your capital in Brisbane, Adelaide, and Perth, leveraging the growth that you have had received, and then taking advantage of the suppressed and depressed markets in Melbourne and Victoria, and even some pockets of Sydney. We are finding have been pretty stagnated for the last 4 to 5 years. We like to buy in areas when they've been stagnated for a good period of time because then it's lowers your risk of the downside, and the risk, the opportunity for the upside is greater because it's only a matter of time that they'll enter their next bull run, and then you get the capital growth. So moving on, monthly dwelling values, so approval, sorry, I should say, is still low, well below the decade average. Um, it is very hard to get approvals over the line um, or getting council approval. It is not getting easier, I say, with inflation higher, with higher cost of materials and labour, and councils are, yes, very restrictive, and the net overseas migration is still driving prices. So it will take probably some time, I think, before it'll then tick up, probably the next year or two, and then construction will really start to kick into gear. But that is still restricting on supply with low dwelling approvals. When there's a restriction of supply, prices will continue to keep rising. Rents are starting to soften. Well, they're still, in terms of the annual growth rate, is starting to soften. So it's down to 8-9%. So for Sydney, Melbourne, and Brisbane, that is still relatively strong compared to average growth rates of 2 to 3%. But they have, yes, passed their peak of 15% in annual growth in 2023, mainly due to affordabilities uh, limits. People, it'll get to a stage where people just can't afford to pay the higher rent, so the growth rate will slow down, and then over time, those higher rents will then get capitalized into higher prices. So moving forward, the 18-year land cycle. I actually caught up with Philip J. Anderson last night. He had a seminar in the city. Very interesting of his key takeaways. Um, he has refined it now to April 2026. He believes will be the peak of the land cycle in the States. Australia typically trails 6 to 12 months behind the States, so we are watching what's happening in America quite closely. Um, and he now believes that we have entered the winner's curse, which is the final 2 years of the cycle where speculation really kicks into gear. Lending's going to start loosening up. People are going to be able to borrow more money, even though they not necessarily can afford it, with zero or very little to zero money down, like what happened pre GFC in 2004, 2005, 2006. You could have walked into a bank and not really prove you even had a job and still be able to get a loan to buy property. So this speculation boom is going to really start to heat up over the next 2 years. And there's going to be more noise around um, the inequality of house prices, as there is a wealth divide between people that have property and hold property will prosper as their wealth and their balance sheet continues to grow and the equity continues to grow, and those who aren't in the market will continue to get left further and further behind. Unfortunately, it's the nature of the capitalist system. And then we'll go through the next land-driven downturn post 2026. So Brisbane, Perth, Adelaide, uh, on their course, uh, overlaying that with CoreLogic's data, but historically in the second half of the cycle, Brisbane, Perth, Adelaide outperform as they decentralise out of Sydney and Melbourne when they become too expensive. That's why Sydney and Melbourne typically stagnate for a good 5 to 10 years in the second half. So we are now sowing our seeds in Sydney and Melbourne over the next few years to capitalise on their next growth runs, which will lead in the recovery stage of the next cycle commencing 2028 and onwards. So we are no longer looking to buy in Brisbane, Perth, Adelaide, these markets. We think the ship has well and truly sailed. We are seeing better value elsewhere in Victoria and New South Wales. So uh, I've moved the marker up slightly We as we are now in this final 2 years run up until Q2 of 2026, which will be the land market peak. So the cash rate, what does this mean for the cash rate? Well, in May of 2024, inflation has ticked up from 3.6% to 4%. Um, that is pretty common, I guess, for the second half of the real estate cycle. Um, Inflation is going to remain elevated and interest rates are going to remain elevated. Rates are most likely going to go up from 4.35%. Uh, the RBA wants to see it consistently within 2 to 3%, the band, the inflation. So when inflation is going up, that is not a good sign for interest rates. Um, I even anticipated rates to keep going up high. If you've looked at my previous videos, this is all backed off the 18-year land cycle. So rates are more likely going to keep rising until the market tops out in 2026. And then once the market turns, then they'll be dropped to zero before you know it. So you need to hang on. Um, there is speculation that they could drop in the next year or two, but until inflation comes down, they are not going to drop the cash rate. If not, they're more likely going to keep rising. So Michelle Bullock, I mean, she's just come in and she's going to um, probably cop a lot of heat, unfortunately. I actually know Michelle Bullock through family, and my mum's actually good friends with Michelle, and great person, great family, and but unfortunately to see that I can see it happening now that rates are going to keep rising, and there's going to be a lot of mainstream noise and media around um, pressure on the RBA and Michelle to try and drop rates. But the reality is the underlying 18-year land cycle is not going to allow them to drop rates until the market turns. So brace yourselves. Time now to cash up. You want to have good, strong, healthy cash buffers, refinance, get your money out of your properties while you can, or potentially even look to sell. Don't be over leveraged because rates are more likely going up from here. To overlay that, we are in equivalent 2005, where we came out of the mid-cycle slowdown. So this is the last 18-year land cycle, and from 2005 up to the peak prior to the GFC, they went up to about 7.5% at the cash rate. So that's a good, probably 10 to 12% at the banks lending. So from here, I do not see rates going down, especially with inflation that has ticked up. They could easily get up to probably 6 to 7% at the cash rate, as what they did in the um, prior to the GFC, before they then get drops significantly down to about 3%, but that will more likely get down to near 0 to 1% again once the market turns post 2026. Inflation or it was coming down, but there's now ticked back up to 4%. So prior to the GFC, which is quite interesting, 2003 inflation was around the 2%, then it dropped down to, or 3% dropped down to 2% in 2004, then 2005, 6, and 7, it then peaked up to 4% and then dropped back down again. So inflation is a lot more higher and elevated than it is a lot more higher and elevated now than it was in the last land boom pre-GFC. So don't expect rates to be dropped in any time soon, especially while inflation is high. Um, yeah, it's going to keep going. So hold on. Politics. So the US presidential debate uh, was completed during June. Uh, Biden's cognitive decline has been made quite clear to the mainstream. Mainstream media, such as CNN, have been keeping him behind closed doors, keeping him caged and away from the mainstream to protect the reality of the situation. That is now put out in the cat's out of the bag now, and 72% of polls now believe that Biden is not fit to be president um, of the US, and let alone not even run for another 4 years. So the momentum is building behind Trump. Um, the Democratic Party are also trying to replace Biden to give them a chance of beating Trump, to bring in someone who's more or younger and more energetic, potentially more likable. Um, but Biden, stubborn old man, in denial, has refused to step down, and he believes he's the best man to take on Trump. So he's going to essentially light himself on fire between now and November. And the mainstream media have now essentially turned their tune of protecting him to then highlighting all his senior moments to almost protect their own brand now, because um, the mainstream media have pretty much in the States have pretty much been lying to the public for the last couple of years, and they are in damage control. So Trump has also received immunity from the Supreme Court, so no more funky business from the Democrats to try and lock him up um, before the polls are completed and votes are taken in before November. So Trump has pretty much taken all that noise and bad publicity in his stride, and momentum is now building. So, what does this actually mean for the markets? If Trump comes in, and it was actually quite interesting last night, I was quizzing Phil J. Anderson about this and whether or not, and because it's looking now most likely that Trump will come in, and if he does come in, will Trump's policies push the cycle further? And he doesn't believe so. So he believes that the 18-year land cycle is a larger beast. It's a living thing. It's a an underlying current, and the White House and the United States only have probably a 10 to 15% influence. Uh, there's more. Um, there is more powers at play or forces at play, including China, India, Russia, Australia, the UK, as well as the States, that all play into the 18-year land cycle of westernized capitalist economies. So if he does come in, though, and he cuts taxes to more than what the Ronald Reagan did in the 1980s, cuts regulations such as lending regulations, so puts the onerous back onto the borrower to make sure that they can actually afford the loans rather than the lender. So that's what happened pre-GFC, where you could go into a bank and get a loan for $1 million and not even prove that you have a job, because the onus is on the borrower to make sure that they can borrow the money and not the lender to calculate whether or not they can afford it. That cutting regulation will boost lending, it will boost property prices, will all filter down to the benefit of property and land values. Drilling oil to lower energy costs, to lower inflation, so he can then ultimately cut the Fed's funds rate. All this is going to come in during the winter's curse, and Phil was saying he still believes the market will turn in 2026, even though these policies will come into place. It won't be enough to push the cycle further, but it the will inflame the volatility of the market. So it'll drive property prices higher and they'll crash harder, but the timing will be the same. So the speculation and the boom, stock market, property market, commodities, land markets, everything is going to start absolutely roaring, and people will get fear of missing out. They'll start speculating. Banks will then try and work out how to keep people borrowing money so they can keep affording to buy property. They could do this by extending 30-year loan terms to 40 and 50-year loan terms, or even getting your kids on the loans, or getting a government scheme to go in shares with people to buy. There will be new ways that will evolve over the next couple of years, 2 years, maybe even using Bitcoin as security to buy property. It's all going to become madness. This is the winner's curse. This craziness is all going to happen over the next couple of years. And with someone like Trump, a very far right politician who has vested interest in property, his actions or his policies are all going to filter down to the benefit of his own interest, and that is property development. So it's only the cycle will stay the same, but the boom will be greater and the bust is going to be even harder. So don't get sucked into buying new and off the plan, the shiny new thing, hotspots. Um, you need to make sure that you do not forget the fundamentals. As now is more important than ever to be cautious with your investments, as people will become emotional, reckless, not pay attention to the fundamentals, and may well end up getting burnt when the market turns post 2026. Exciting, thrilling times ahead. Make sure you're not over leveraged and not getting carried away with the herd. So just a disclaimer, this is general content in nature. This is my thoughts. This is by no means no advice, no personal or general advice in nature. Prior to making any investment decisions, you should obtain independent legal financial advice, tax advice. I operate as a buyer's agent, though. If this resonates with you, hit me up. I can shoot you some information about the services I can provide if you are looking to buy an investment grade property. If you have any questions, feel free to email me at geordie@williamsrealestatecompany.net. Happy to receive your questions, queries, feedback, anything you would like to see in these videos moving forward as we enter the last few stages of the 18-year land cycle. And I can help to provide more education awareness of the current boom that we are in and the inevitable land-driven downturn bust. If you think this content is valuable, please share it to anyone that you think would see a value of it. Like, subscribe, put comments in. I'll respond to all the comments, queries. Until next time, thank you very much for watching. We'll see you then. Take care.